All right. So this video is going to be about the reserve requirement. I feel like we should talk a little about the reserve requirement before I go into a more detailed explanation of the multiplier, which is kind of the big thing for monetary policy, much like the GDP multiplier is the big thing for fiscal policy. But if you remember, we have three tools of monetary policy that the Federal Reserve can engage in, which is the reserve requirement, lowering and raising the discount rate, and open market operations. And so we're going to do the reserve requirement here. All right. So with that, let's do a balance sheet really quick. We have assets, we have liabilities. So if somebody deposits money at a bank, say Cloud deposits money at the bank, Cloud's going to get a demand deposit account of, we'll just say $100. Obviously, the numbers are much bigger, but for this, we'll just use smaller, easy to math numbers. All right, so he's got a checking account for $100 at this bank. The bank gets $100 in reserves. In other words, Cloud walks in, deposits the money. The bank has the money. If they could, the bank would loan out all of this, all of it, because they can charge interest on it. And so that's bad, because if Cloud then wishes to withdraw his money, the bank doesn't have it. And so the Federal Reserve, which actually can exert policy over member banks, all the commercial banks in the United States, kind of have to adhere to the policies of the Federal Reserve. That's one of the Federal Reserve's responsibilities. So the Federal Reserve will actually tell banks that they have to keep a certain amount of money on hand as reserves to cover any withdrawals that may happen. This is the reserve rate, or sometimes called the reserve ratio. Okay, and it's a percentage. So the ones we're going to be dealing with for the AP test are going to be 25%, 20%, 10%, and maybe 5%, but probably not. If you look at old AP tests, you'll see that it's one of these three. And the reason is, just like the GDP multiplier, those turn into easy math for the multiplier. All right, so let's just take 20%, for example. And what ends up happening is, if the reserve rate is 20%, the Federal Reserve sets the reserve rate at 20%, then that means that if the bank has $100 in reserves and $100 in demand deposits, they have to keep, the reserve ratio is the percentage of this category that they have to keep here, not any other category. So if the bank gets money from other means, a loan from the Fed, the sale of bonds, then that money they can loan out all of it. It's the percentage of this that they need to keep here. Okay, so if we have 20% here, then that means that as a reserve rate, that means that it's 20% of this 100. So this bank then would need to keep $20 in reserves, meaning they could loan out 80. So what would happen is this, when they did that, this would become 20, and then the loans would become 80. Okay? So it's just like that. So any new deposits they get, they can loan out a portion of it. Let's look, actually, at what would happen if, say, okay, so assets, liabilities, we'll just say they have reserves of 10, demand deposits of 100. We'll make this loan, we'll make this securities of 90. Okay, this bank balances. Yeah, okay. What this means is, if this is the case, and this bank has no excess reserves, so no excess reserves, what that means is then that this bank does not have any more loanable funds it can loan out. That means that if that's the case, then the reserve rate in this instance is 10%. Okay? So you possibly see my family or hear my family fighting in the background. If this bank got another, say, $50, so this becomes $150, and then this would become $60. Okay, 60, 150. We have 150 here. We have 150 here. They balance, but this bank only has to keep 10% of this here. So they only need to keep $15, but they have 60. So they can loan out another 45. So then this would become 15. This would become like that. Okay. We'll get a new piece of paper. And I'm going to show you something that the College Board does that I don't particularly love, but they do it, so I'm going to show it to you. So required reserves. They actually, demand deposits. They actually separate out the required reserves and excess reserves as two separate categories. And that's fine. So in this case, if the reserve rate is 10%, it would look like this. So we have $100 and they have $100 in reserves. Of that, 90 could be loaned out. And then when that got loaned out, this would zero out. This would become zero. And then we'd create a category of loans for $90. Okay, that's fine. I understand that. I understand why they do that. It can be useful if you don't know the reserve ratio. So if you don't know this and all you get is this, then you know what the reserve ratio is. You know that the required reserves is 10 of 100. So that's 10%. So that's useful. The downside is, I personally like to just have one category of just total reserves and then do the math in my head when possible. And the reason is if somebody deposits another, say, $500, so this becomes a demand deposits of $600. Okay? If somebody does that, you now need to figure out where the money, you have to put money in both categories. So of that $500, they have to keep 10%, so that's 50. So 50 will go into here. So that's 10 plus 50, which gives us 60. And then the other 450 goes in the excess. So that's 90 plus 450 is 540. All right, so I know it's messy. So 540, let's see, 540 and 60 is 600, 600. Okay, if you like doing that, you can do it that way. It works just fine. I don't like having to sort out the money into two different categories. It feels like kind of a pain for me. But yeah, that's what you can do. Let's try it this way. Let's see if this works better. Okay, so let's say that this bank looks like this. DD 1000 reserves. We'll call it 500. And we will say that they have bonds or securities in the amount of 500 as well. Okay. Now, if we were to say that this bank, the reserve ratio equals 20%, what you might be asked next is, what are the bank's required reserves and excess reserves? or how much money could the bank loan out. In this instance, there's $1,000 here. So they have to keep 20% of that 1,000. So 20% of the 1,000 would be 200. But they have 500, meaning they can loan out 300. So let's do that. We would turn this into 200 and then create $300 in loans. Okay? That's basically how the reserve rate works. And the Federal Reserve uses this as a tool of monetary policy, which is kind of the whole point here, right? Not just for security for the for you when it comes to banks, but they use it also because when they raise or lower this number, so say we drop this down to 10%, suddenly the bank only has to keep 100. They could loan out an additional 100. What that does is that'll actually create more loans, which will shift the money supply out, which will create investment because of lower interest rates and restore full employment. So that's kind of the general thrust of reserve rates. Next, actually, before I go into open market operations or the discount rate, I'm going to talk about the money multiplier and kind of more what it does and the bigger effects of it. All right.